Hi there, I'm Stan the Annuity Man. Welcome to the Annuity Man Live. Man, you're up, you're drinking your coffee like me. I've got I've got tea. I did coffee first, tea second. But I'm glad you joined us. Today's topic's a good one. Do you even need an annuity? To ask that, the sales guys are saying, Stan, stop it, stop it. The annuity industry is saying, stop it. Let's take a look at a couple of things before we get started. Put those questions in there. We'll hit them as fast as we can, and obviously I'll be brutally factual. Let's show the site. The producer put up the site. If you haven't been to my site at theannuityman.com, you can book a call. A lot of the times you get me, not all the time, but a lot of times you do get me. We do have some other experts that I have deemed appropriate, and they have passed the Stan sniff test, which is a big one. You can use our calculators. Go there. You can run SPIA, DIA, MIGA, QLAC, Income Rider quotes at your leisure, 24/7, 365, quoting all carriers. We do have books that are hard copies are available just for a limited time. Coming up soon, they will be no more, as they say. We're going to do some virtual stuff, some PDF stuff, and I'm rewriting the book, which is kind of cool. So let's get to the topic today. It's a good one. Do you even need an annuity? First of all, you already have two, and you're going, wait a minute, Stan, you've already told me about the one, which is Social Security. You always pound on the table. Social Security is the best inflation annuity on the planet. You're right. I'm glad you said that. I say that all the time. But the other annuity that you have is your IRA when RMDs, required minimum distributions, happen at the time of this taping, age 72. Say, wait a minute, Stan, that's not an annuity. It's a forced annuity is what I call, because at 72, what's the IRS do? Hey, excuse me. I know you don't need the money, but you're going to have to take some out so we can tax you on it. That's a forced annuity, and they're going to do that for as long as you live, and that IRA is in place. So you have two annuities in place. The question then is, do you need another one? And I've made this very, very simple. In a complex world where there's sales pitches and bad chicken dinner seminars and steak seminars, and this is the best too good to be true product, you ask two questions. What do you want the money to contractually do? When do you want those contractual guarantees to start? Because you own an annuity for what it will do, not what it might do. And the will do is the contractual guarantees. You never, ever, 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 ever buy any type of annuity for hypothetical, theoretical, back-tested, Mr. Jones, if you'd owned it 10 years ago, you'd have made this. Any of those unicorn chasing the butterfly nonsense proposals, don't buy it. If it sounds too good to be true, without exceptions, it is with annuities. I mean, it's just that simple. And the other thing that's happening right now is the too good to be true upfront bonuses. I got an email the other day from a company that would love for Stan the Annuity Man to sign off on their annuity with a 35% upfront bonus. Now, if anyone out there just heard that and went, oh, that sounds good. No. There's 100 pennies in the dollar. And if you're buying the annuity for the bonus, it's like buying the car for the stereo system. You're the rube at the table. You're the sucker at the table. You have turned your IQ off to believe that there's a philanthropist giving away money. And there's no one-size-fits-all product out there. If you're trying to solve for something, and remember, annuities solve for four primary things. The acronym that I have come up with is PIL. P stands for principal protection. I stands for income for life. L stands for legacy. The other L stands for long-term care, confinement care. Notice there's no G for growth. Annuities are not and should not be purchased for market growth products, market growth strategy, market growth hopes and dreams. It's PIL. And if you do not need to contractually solve for one or more of those items in the PIL, you do not need an annuity, which is kind of what we're talking about here. Do you even need one? Most of the people that contact us are either looking for two things, primarily principal protection, and there are products, fixed products that protect the principal. You're not annuitizing, you're just protecting the principal, getting an interest rate, etc. Then a lot of people call us for income, because annuities were put on the planet in the Roman times for lifetime income, and it's still the only strategy that provides income as long as you're breathing. You can structure it so that the annuity company doesn't have to keep a penny, but it's a pension product, whether you want the pension to start now or you want it to start in the future. That's the reason I call Social Security the best inflation annuity on the planet. It pays you for as long as you're breathing. It's an annuity, period. So with that, let's jump into the questions and let's get rolling. All right, producer, what do you think? From Peter, can you change your beneficiary after you signed up for a SPIA? Now, it depends on, the answer is yes, Peter, and it depends on how you structure the SPIA. So let's just say there's 40 different ways, 40-ish. If you said life only, what's life only, Stan? That means if you step out in front of a bus day 2, and get killed, money goes poof. And not many people do that. Some do that don't want to list beneficiaries. But if you have any type of life with cash refund, life with period certain, life with installment refund, any type of guarantee on the back end, then yes, you can change your beneficiary. And yes, you need to list beneficiaries at the time of application, of which my team takes care of. But it really comes down to the structure. Most people have really worked hard for their money and they want a lifetime income stream, but they want to make sure that some, all, part, whatever your decision is, and that's what you need to talk to us about, that money is going to go back to their family when they pass away, then beneficiaries are very important. And you have to understand too, Peter, that you can change beneficiaries. So if your son makes you mad, you can remove them. Okay. And then if they get in your good graces again, you can put them back in. Our team handles that for you, get you the right forms to change beneficiaries. I would encourage you to always update, look at your beneficiaries on your life insurance policies and your annuities, etc. Okay. Next question.
Okay, we have a question that was emailed into us. And if anybody has any questions, please feel free to post them. What has been your experience comparing fixed indexed annuities with income rider versus single premium immediate annuities for one that is looking for highest lifetime income? That's part one of the question.
Okay. Part one of the question. Well, it's income riders are for what I call income later. And income later is when you want the income to start a year or more down the road. Okay. So if you say, Stan, two questions. What do you want the money to contractually do? And when do you want those contractual guarantees to start? Then if you say, well, I think maybe 1 year or 3 years or 7 years or 9 years, we're going to quote income riders and deferred income annuities. So that's where that lands, income later. With immediate annuities, it's a year in. So if you said, I want the income to start, 30 days, 60 days, 90 days, or, 2 months from now, whatever it is, a year in, then an immediate annuity is going to provide the highest contractual guarantee available. Because remember, the reason for the two questions is to pinpoint the type of annuity product that's going to provide the highest contractual guarantee for your specific situation. That's the reason I come back to there's no one size fits all. So to compare income riders that are typically attached to variable annuities or indexed annuities provide the higher contractual guaranteed income riders in most cases. It's almost an apples and oranges comparison because income riders are a future pension plan. In other words, if you bought an income rider today, we could tell you contractually to the penny what your lifetime income stream would be in 5 years, 7 years, 1 year, 2 years down the road. For your planners out there, that makes a lot of sense. Now, let me go another direction with that and ask a question that's probably on some people's mind. Do you have to buy the income rider, or should you wait to maybe buy the immediate annuity at the exact time you need lifetime income? And that's what I call defer to SPIA, meaning that you might not buy the annuity now. You might buy it, the immediate annuity, at the time you need income. Give you an example. I had a call the other day and the person said, should I buy a deferred income annuity or income rider? And the plan was to turn on the income stream in 5 years. Or should I wait the 5 years and buy the immediate annuity at that time? Say buy a 5-year multi-year guarantee annuity, get an interest rate, and then transfer that to the highest paying immediate annuity at that time. As I tell everybody, there's no good answers, just bad sales pitches, right? There's no perfect answers to that. But there's an argument in the environment that we're in right now, and look at the date that this is being recorded. Interest rates are allegedly, supposedly planned to go up by the Fed. Now, at the time of this taping, there's some intervention with Russia and Ukraine that might throw a wrench into that interest rate raising engine. But if it does go up, even though lifetime income is primarily based on life expectancy, interest rates do play a secondary role. So it might make sense to buy a MIGA now, 5 years, get it at the time of this taping, you get a little bit more than 3% annually on a MIGA. And then at the time you need income 5 years from now, we can transfer that and shop all immediate annuity carriers for the highest contractual guarantee. Now, with that being said, do the annuity companies know that I just said that? Do they know that's what you're thinking? Yes. So what do? They make it a tough choice, meaning that if you bought a deferred income annuity today or an income rider today and turned it on in 5 years, they're going to reward you for letting them hold on to the money. They're going to enhance that payout at the 5-year point. So it's a tough choice. I really tell people, go with your gut feel. If you want to lock in those guarantees and know to the penny in 5 years what it's going to be, then great. Let's lock it. Let's quote deferred income annuities and income riders for the highest income later quote on the planet. Or you might say, you know what, I just don't want to do that. I want to hopefully catch rising rates in combination with the life expectancy pricing, and let's buy it 5 years from now. So it's just a very, very tough way to do it. And as I always tell people, because there's no perfect answers, you might want to what's called split the baby, as they say in the South. And if you let's just say you had $500,000 in mind to do that, let's take $250,000 and buy an income later now, lock that in, take the other 250, buy the 5-year MIGA with the understanding that we're going to convert that to an immediate annuity after 5 years. Because again, there's no way to pound the table which one is best. I think there's a second part to that question, Miss Producer.
There is. With a FIA, there is the potential for future increase in one's income payout with the benefit base account growth due to the elected crediting index strategy above the FIA's contractual guaranteed payout. From your experience, have you seen a future income increase from an FIA with an income rider generating a greater lifetime payout versus from an immediate level payout from a SPIA?
The answer is no. And that's part of the bad chicken dinner sales pitch, where people will say to you, indexed annuity salespeople will say, I have this index annuity that increases with inflation. That's going to increase every time the index increases. Are there such animals out there? Correct, there are. And just spoiler alert, we love index annuities. We sell index annuities. We just don't pitch them and shine them up and fraudulently misrepresent them. We don't. They are CD products, period. They were put on the planet in 1995 as a CD product. That's exactly what they do. That's exactly what their historical returns show. But there are, just think logically. Annuity companies don't give anything away. I always say they have the big buildings for a reason. So if anyone says that the income stream is going to increase with the index increase, doesn't that sound too good to be true? Nod your head. Of course it does. So what does the annuity company do if they offer this type of product? And of course, we offer it too, if you want to look at it. They severely and significantly lower that initial payment by anywhere from 20 to 30%. We've seen it as high as 40%, depending on the product, et cetera. Meaning that if you bought an income rider, okay, without the increase, it's going to be 20 to 40% higher than if you bought the one with the increase. Got it? Same thing with immediate annuity. If you bought an immediate annuity with a cost of living increase, the annuity companies are going to significantly lower that payment to make up for that. Typically, and we've looked at it, there's no tried and true rule. It's a 6 to 9 year break even point. Once again, the way to filter this out, if it sounds too good to be true, it is every single time. And if you're buying annuities for what they will do, not what they might do, then you're not going to buy that product. Which leads you to say, wait a minute, Stan, how about inflation? This guy's talking about inflation and you're really not talking about inflation. So let's talk about inflation, because that's what this is all about. You want to find that perfect product that increases and adjusts and floats with inflation. It doesn't exist just in the sales pitch. So how do you do it, Stan? Here's how you do it. Everyone has an income floor. Everyone has an amount of money that they need to hit that bank account every single month, period. Everyone's different. It could be 5,000, 3,000, 7,000, 10,000, whatever it is. But so you solve for that. Use as little money as humanly possible to solve for that. And on all of our calculators, you can run what's called a reverse engineered quote, meaning, well, Stan, we need $2,225 a month right now to fill in the gap. Well, then let's solve for that and use the least amount of money to do that. But when inflation hits, and inflation is customized and personalized to your situation. So I know that the media thinks that everyone's inflation. Inflation, it hits all of us differently. Nod your head. It's true. So let's just say your situation is right now you need $5,000 a month. And we solved for that 2 years ago. But now with inflation, you need an additional $250 a month for that income floor. Guess what we do? We do a reverse engineer quote for an immediate annuity solving for the $250 a month, joint life, single life, whatever you want to do. And then if it happens again, we do it again. In other words, we use the least amount of money to solve for that specific inflation need for the income floor at that time. To answer your question in a roundabout factual way, the index annuities that are being pitched out there that increase with inflation with the income stream are too good to be true. They're not bad products. They're just too good to be true. You're better off doing it the way that I told you to do it. So don't fall for the sales pitch. Don't fall for the back-tested numbers. Don't fall for, well, if you'd owned it 10 years ago, it would have done it. Don't fall for that. period. And by the way, I'm pounding the table with the industry to make that illegal. It's never going to happen, I don't think, but I hope so. So people don't show back tested numbers. That's crazy. You should base your decision on the contractual guarantees. And I understand, well, Stan, well, I've kind of got to know what the index. No, you don't. Look at the index that's being offered, whatever it is. Look at the participation rates, caps, and spreads. We'll help you with that. And let's base the decision on today, not 10 years ago. You know better than that. Don't fall for that. All right. I think I answered that question. What do you think? Any other questions? David Teston, does it make sense to have an annuity inside of a Roth IRA? That's a really good question and a loaded one. So let's go through that. In a perfect world that I live in, where the unicorns do chase the butterflies, if you have a Roth IRA and you have an IRA and you have some non-qualified money, you've already paid taxes on the Roth IRA amount. In a perfect world, that's where your non-annuities should go for market growth, real market growth. But I had a call the other day and a guy said, Stan, 80% of my money is in Roth IRAs. We've converted most of it, and 80% under that scenario, then it does make sense. And if you put money inside of if you put an annuity inside of a Roth IRA and you take money out, whether it's a lifetime income stream or withdrawal or interest, whatever type you're getting, obviously that money taken out is tax free. But when we have the conversation, whether it's with me or my team, we're going to say, okay, give us the 30,000 foot view. How much money do you have in your IRA? How much money do you have non-qualified? How much money do you have in Roth? If there is a way for us not to use the Roth and for you to keep that in ETFs and crypto and mutual funds, whatever growth means to you, then we're going to advise you to keep that Roth for pure growth. And anytime I use the G word, anytime you're looking for market growth, means you should never, ever, ever, ever buy an annuity of any type, period. I don't care what anyone says, shows you, videos, whatever. I don't care what their sales pitch is. If they're saying market growth, then they should not be talking about annuities, period. And that's coming from someone who worked for Dean Witter and Payne Weber and Morgan Stanley and UBS. I understand markets. I understand growth. I understand it. I managed it at a very high level for a very long time. So it's kind of funny, when I came out to the annuity world and I heard indexed annuity sales pitches talking about market growth, I'm going, wait a minute. First of all, that's not a security, so you really can't say that legally. Second of all, that's not what it was designed to do in 1995. It was designed to compete with CDs. Indexed annuities are not bad products. We primarily use them for the delivery system for income rider guarantees. But what indexed annuities do on a standalone without the income rider, it gives you a better than average chance of getting a better than average return, say like on a CD. Just remember that. It's just, you might get 100 basis points more than a CD, 1% or 2% if the planets align themselves. But if you go into any indexed annuity thinking you're going to get market growth, you're not. And the people that own them out there on this call, they're nodding their head. They know that it's true. All right. I think I got that one. All right. YouTube user, good name. Don't have a ton of money, looking at retiring shortly. An agent recommended an annuity, but it only has a B rating. I'm concerned I can't afford to lose money. Good question. Really good question. Number one, annuities are commodity products. There's not, if anyone says this is the best one, it's not, period. They're commodity products. So you have to shop all carriers for the highest contractual guarantees out there. And, it depends on the type of annuity. There are some times that we'll sell a B double plus MIGA. That's a 3-year or a 5-year, a B double plus MIGA. That's a 2-year. Why? Because we're only marrying for that 2-year time period. But my opinion on the B rated is, if you're buying a lifetime income stream product, I would go with a higher rated company. Now on our site, we list Comdex scores, and you can pull that up. If you scroll at the very, very, very bottom of the website, you'll see Comdex rankings. Maybe producer, you can show that while I'm talking about this. In Comdex, we like it. It's not perfect. It's a 1 to 100 score, but it shows the AM Best, Standard & Poor's, Moody's, and Fitch ratings. So, I think, show them where this is. And we give this away for free, updated every single month. But if you go to we don't have to go there, producer, just show them where it is. See Comdex rankings right there. If you click that, it'll take you to a screen where you can download a PDF. It's 20 pages. It lists all the annuity carriers on the planet, and you can look at the ratings. But getting back to your question, I think you will find, if you contact us, we'll shop all carriers based on your customized situation. We'll find an A-rated or A+ rated carrier that I would probably predict is either better from a contractual guarantee standpoint or really close. If this agent's only showing you that, then you need to walk away and you need to you need to contact us and have us shop all carriers. Here's another thing too, and this is very important. People always ask, how much money should I put in? And there's no good answer to that, just bad sales pitches. But the bogey that I put on this question is, you should, once you're at 50% of your portfolio in annuities, that kind of is enough, and you need to convince me why you need to go further than that so I can make the case to the carriers. But that's not just my rule. The annuity industry as an industry leans on that 50% of your portfolio. They don't want people putting all their money into an annuity. Does it happen? Do agents get away with that? Yes, they do. Unfortunately, whether they fill out the paperwork fictitiously, I don't know how they're doing it. But the bottom line is they shouldn't do it. It's really at 50%, you should be saying, wait a minute, what am I doing here? What am I trying to solve for? Do we have clients more than that? Yes. There's specific situations of which have been explained to me, of which I have to go into the carrier and make a case, in my opinion, acting as every financial advisor should act as a fiduciary, and saying, I think this is in their best interest. And so keep that in mind too. So if you have $100,000 and someone's saying, hey, put all $100,000, no, don't do that, period. Okay. Next question. If you move to another state or another country, does that change the terms of a SPIA? No, it doesn't change the contractual guarantees. If you move to another state, the only thing that changes is the state guarantee fund coverage of the amount that you put in. We do have some clients that expatriate. I just got one the other day, and they were living in the state of Washington, and they're moving to Puerto Vallarta, Mexico. They had already purchased a house there, and they have a banking relationship with a large bank that has branches all over the world, and it's just gonna they bought it here, and they're gonna move there 2 years from now, and it'll just be money going to the bank account, and they can use it in Mexico. So yes, you cannot buy an annuity from another country. You have to be in the country, a resident of a specific state with a social security number to buy an annuity, period. Ronnie Pugh, why don't more couples choose the wife as a single annuitant instead of taking the lower paying joint life? My wife is 7 years younger. There's almost no chance I survive her. That's a really good question, Ronnie, because when you do joint life, in this situation, Ronnie does it and his wife is 7 years younger, and it's joint life. Let's just say they choose joint life. What does the annuity company do? They ignore Ronnie. They look straight at her and say, we're going to base our life, the payment on her. So Ronnie's gut instinct's pretty good. If you're going to do a lifetime income stream and you're that much older than your spouse, okay, it probably would make sense for us to structure it so that it's on your wife's life, okay, and you can have a cash refund or installment refund in case something happens to her. Because remember this, and this is common sense, when an annuity company guarantees a lifetime income stream, okay, the payment's going to be higher for one single life than it would be on a joint life. So Ronnie's instinct's good here. I'm glad you brought that question up, because in this specific situation, it should be just on her life. I did one recently this week, I believe, and the differential was 14 years. And the gentleman had heard me say, you need continuation of the income stream, uninterrupted and unchanged for the spouse. But what I told him, I said, hey, player, you're probably not going to outlive your wife. You're 14 years older. Let's just put it on her life with cash refund, making sure that 100% of any unused money goes to you if she dies early in the contract. But most likely she's going to outlive you, and she's going to get a higher payment. That's obviously going to continue uninterrupted and unchanged when you die, because it's on her. So to answer your question, Ronnie, in your specific situation, it should be on your wife, period. Jason was on the call early. Thanks, Jason. I appreciate that. You're 44 and you're 41. Okay. Here we go. Now, you should not buy an annuity. Okay. If you're less than 50 years old, and now you can schedule a call with me and put in that call. I really want to stand on this because I was on the call. But in most cases, you're too young for an annuity, because the annuity company looks at you and your wife, 44 and 41, and they say, you know what? You have 40 plus years of life expectancy. And they're going to base that, if you're buying a lifetime income product, they're going to base that payment and stretch it out over those 40 years. My opinion, you'd be better off not buying an annuity of any type keeping your powder dry, keeping the money in real growth products. That means non-annuity, and then calling me or my team. Once you pass that 50 threshold, I think I know that was part of your second part of your question, but I wanted to just step in here because I get a lot of calls from people saying, I'm 42 or I'm 39 or I'm 46, and someone's trying to sell me this annuity. That's just inappropriate in my opinion. And it's not suitable. But when you get to 50 and you have $100,000 each, yes, you can roll your IRA over and buy an annuity. But there is an early withdrawal penalty, as you pointed out on this question, depending on the type of annuity. Let's look at, say, if you bought an index annuity or a multi-year guarantee annuity, and you're taking, or an income rider with that, and you're taking money out, okay, pre 59 and a half, there's going to be a penalty. If you buy an immediate annuity that's annuitized, I know I'm getting the weeds here, but hang in there with me. Before you're 59 and a half, you circumvent those penalties. But the question truly is, why are you doing that? And that's what I want to find out. If you are, 52 or 53, you need to tell me why that you're trying to buy an immediate annuity or something for lifetime income at that young age. If you're buying a principal protected product like a multi-year guarantee annuity or an index annuity, I'm going to remind you and say, hey, this is okay if it meets the qualifications of what you're trying to do, solving for principal protection or income, legacy, long-term care. But I need to remind you, you can't withdraw money pre 59 and a half if it's one of those deferred type products. So I think the bottom line with this question is, the answer is yes. You can buy annuities, you can roll your IRAs into annuities, etc. But the bigger and better question is why? Why are you doing it at at an old age? I mean, young age. You should kind of wait. And if there's a reason for you to wait, I'll tell you. I had a call this week. Similar situation, person was in their 50s, they've been sold annuities. I said, you know what? You really don't need them right now. Wait till you're maybe 55, contact me because they told me their situation. Your situation, Jason, might be totally different, but at the end of the day, you're very, very young in the annuity company's eyes. So you need to make sure that you're doing the right thing and not locking up money. Because understand this, annuities are transfer of risk products. So you're transferring the risk for the annuity company to solve for lifetime income or principal protection. At the age that you're at, and even at age 50, the question is, do you need to transfer risk? Which leads us back to the title of this live event. Do you even need an annuity? In your situation at your age, the answer is yes, but probably not right now, or yes, but maybe later. Everyone eventually is going to need lifetime income. Everyone eventually is going to need principal protection. The question is it time for you to transfer risk? Something we need to talk about for sure. Next question. Alicia, is getting a long-term care component to your it seems that only for 5. Okay, what you're talking about, and everyone's reading that on the screen. What she's talking about is an indexed annuity that has an income rider, and it's been pitched as long-term care. Well, you get this income rider, and if you get sick, it'll double for 5 years. Sounds good. Okay, it's a guaranteed issue, but that's not long-term care. Understand this. And my friend Jack Linenberg, who's the #1 long-term care expert in the country, and he's been on some of my podcasts. By the way, have a podcast every Tuesday called Fun with Annuities. Check it out. But Jack says if it's not tax-free benefits, then it's not long-term care. So the question to this agent who pitched it is, oh, that's great. It's long-term care. Is it tax-free? They're going to say, no, it's not tax-free. Then you say, okay, great. It's not long-term care. So what is this, Stan the Annuity Man? This is what's called in our business confinement care or an enhanced benefit. Let me give you the Southern version of that. When you get sicker, you get your money back quicker. That's all this is. In other words, when you can't do 2 of the 5 daily functions, as an example, they all have different rules, but let's just say that's the example. And what are the 5 daily functions? Feed yourself, clothe yourself, bathe yourself. I mean, if you can't do that, life stinks anyway. But the point is, they double the income. So let's say you bought the index annuity with the income rider, you're getting $10,000 or $5,000 a month, and you get sick and you qualify for this confinement care. They're going to increase it to $10,000 per month for that 5 years. Why 5 years? Because once you qualify, you're not going to live past that in most cases, just mathematically, historically. Should you buy this? If you're looking for real long-term care, no, you shouldn't buy this. Should you buy it? Should you cash in your long-term care and buy an index annuity with confinement care? Heck no. You should never do that. You should always look at true long-term care, and I will send you Jack Lindenberg. You can go to my site. He's got pages on there on the podcast where you can contact Jack, have him exhaust all long-term care possibilities. This, what you're talking about here, Alicia, is the last resort. After you talk to Jack, after he's shopped all carriers for real long-term care that's tax-free in the benefit side, and he comes back to you and says, I can't do anything, you don't qualify, then we come back and look at this product. But this is nothing more. This should never be used as primary coverage. This is only supplemental coverage. And shame on that agent if they use the word long-term care to describe it, because it doesn't apply. Okay? Long-term care equals tax-free. This is not tax-free. You're getting your money back quicker when you get sicker. They're enhancing it and increasing it during that 5-year time period. And if you live past the 5 years, then the income stream goes back to the original amount that it started before you got sick. I don't think this is a great benefit, but for the person out there that's drinking a bottle of Jack Daniels every single day and smoking Newports, the menthol version, every day, 2 packs a day, and they can't qualify, then this is your only option. But this isn't and shouldn't be your first option, if that makes sense. Kent, for IRAs with RMDs required, are annuities appropriate vehicle in the IRA to fund the yearly RMDs with the allowable withdrawal percentage? The answer is yes, Kent, you can do that. There's, most annuity types are RMD friendly, and qualified longevity annuity contracts are actually designed for use in IRAs, and can possibly and potentially reduce the taxes on your RMDs. But let's take a specific examples. Let's just say, okay, Stan, I want to protect the principal. I just want an interest rate, kind of like a CD. Let's buy a MIGA, multi-year guarantee annuity, keep the duration short, and then choose the multi-year guarantee annuities that are RMD friendly. We know which ones those are, which means that you're going to get the interest rate, but then you can pull out the RMDs that's needed and not disrupt the policy. But the other way to do it is if you said, Stan, we need lifetime income. Me and the wife need lifetime income. Then we would buy let's say an immediate annuity. Let's just say you had $1 million IRA and you took $300,000 and bought an immediate annuity inside of your IRA, and you're getting income from that $300,000 SPIA inside of your IRA. That income coming from that immediate annuity is fully satisfies the RMDs for that immediate annuity amount, that $300,000. Then you'd have to take RMDs on that additional $700,000 in this $1 million IRA example. So yes, you can use them. It's something that we need to talk about one-on-one, just because it is customizable. And I want to hear what you're trying to do, what you're trying to solve for. Make sure you're not putting too much money into an annuities. Getting back to the title of this event is, do you even need an annuity? Under this premise, if you said, Stan, I kind of want to turnkey some of my IRA from an RMD standpoint, then we can do that and provide lifetime income stream. You can set up for your life or your life with a spouse. So it is doable, but it is customizable. Okay.
We have 2 questions about the 50% rule, so I'll put those up on the screen.
Here we go. Does the 50% rule apply to each or a combination? Combination. I'm looking at it as a household. So here's the bottom line, Richard, and everyone out there listening and viewing this. You don't want to put too much money in annuities. And that's coming from the top annuity salesperson in the country. I mean, and I'm the first one to say, you can't go all in. We're going to reverse engineer quotes to solve for income. If you say, Stan, I want principal protection, I just want to do MIGAs or index annuities, that's fine. But we just need to make sure that you keep enough money, A, in cash, and B, in real growth investments, so that you can, your portfolio is going to grow. But it does apply to a household, okay, not just an individual. Chuck, does the 50% ratio of your total portfolio also apply to the money I may want to put into MIGAs? Yes, it does. It does. And I'm one of the few people out here, I get angry letters and calls and emails from agents that are mad because they were trying to sell someone 80% of their portfolio in annuities. I don't think a lot of agents even know this. The annuity industry has not done a great job of kind of promoting this. And I think the reason is because it's not a tried and true rule. It's a suggestion. It's a recommendation from the annuity industry that they don't want to put too much money into annuities. Because there was a time, a decade or so ago, that suggestion recommendation was not in place. And and there were people selling 100% of everybody's money. Now, there are times, and we had a time that I think it was 2 weeks ago, and a gentleman said he had some annuities. He wanted to put more in. In other words, he wanted to cross the Rubicon of 50% and maybe go to 60 or 65 or whatever it was. And we went to bat with the carrier. We said, hey, this guy's qualified. This is the reason that he wants to do it. The reasons made sense. It was in his best interest, and they turned him down. Why? Because their comment, the annuity company, was he had, in their eyes, he had too much or enough in annuities at this point in time, and they didn't feel comfortable accepting more money based upon the annuities he already owned. So the people that are looking at the paperwork at these annuity companies are going to look at, obviously the agent can, we're going to be obviously honest and truthful on the application. My team is fantastic that does that. But there are some agents that know that rule that are going to get around it and kind of beef up the number so that it doesn't exceed that 50% rule. That's the reason some of that stuff comes in, and people will call me and say, Stan, I got 80% annuities. I'm trying to figure out how. And that's how. Is I'm not accusing anybody of anything, but that's the only way it gets across in a lot of cases, because companies, carriers do not want you to have too much money into annuities, and they will turn down the business and not accept your money if they look at it from a compliance standpoint and deem the fact that, hey, he's already got too much, in our opinion, as the carrier, and we're not going to accept it. We saw it happen just recently with one of our very, very good clients. Teresa, do MIGAs have a death benefit, or does each charge a fee to include beneficiaries? Very good question, Teresa. Virtual high five. When you go to my MIGA feed, and maybe producer kind of show people where they can look, and like everything on my site, you can look at this stuff 24/7, 365. And just show them the MIGA feed. If you go to that front, there's the MIGA feed. But if you go to the main page, if you would. So here's the main page. And if you say, I'm going to check see that see live rates where she is. If you click that, it takes you to, the live MIGA feed. And then all you have to put in is your state of residence. And then what years. Let's go through that real quick, just to show people. We pulled up Alabama. That's 3 years. Okay. So that's that. And again, choose your own state as to drop down, but go back. Okay, Stan, what's a 5 year? Show them how to do that, producer. Is you click to change the state years, and then you put in the 5 year, and then it pops up. So that's how it works, live feed, etc. But to answer your question, Teresa, which is phenomenal, and I'm glad you brought it up, some MIGA carriers, when you die, there's no penalty, etc. Your listed beneficiaries get 100% of the money penalty free. But some do charge a surrender charge to your beneficiaries when you pass away. And we'll tell you that. We'll say, okay, this one has a high rate, but if you die during that surrender charge time period, there's a surrender charge for your beneficiaries. Most do not do that, but some do that. So you have to be very clear with us on your intentions. Do you want to make sure that your beneficiaries don't have that surrender charge? Or do you want to just, in some cases, some of the higher yielding MIGAs will have the highest yield, but yet they'll have that surrender charge for beneficiaries. So you just need to be very clear with us. We're certainly going to ask that question of you at the time of application. Okay, what do you want to do with beneficiaries? Are you okay with this, etc.? But there's nothing uniform in the annuity industry, even though it's a commodity type industry. Carriers put out products like MIGAs, and some of them have the death benefit that's penalty free, and some do not. Good question, Peter. So if you move to another country, there's no guarantee in case the annuity company you have. I don't think so. I don't really know that answer. I'm not going to bluff. I've never been to that rodeo before. I've had a bunch of clients move to Costa Rica and Nicaragua and Panama and now Mexico. We've never seen that happen to where there's been a default situation with an annuity company. And did they pay? I'm going to guess no. Okay. Just because you're no longer a citizen of the United States. But to give you some solace there, the annuity industry is not smarter than banks. They're just more regulated than banks. In my opinion, that's the reason you haven't seen issues with them, because they can't go crazy with your money. And they can't do stupid things. They have to put your money with the fixed annuities and investment grade bonds. I know we can go down the conspiratorial rabbit hole with that one. But the point is, we really haven't seen any hiccups in the annuity industry. But if you move to, let me put it like this. If you are thinking about moving to Panama and you want to buy an immediate annuity here first, then I would buy it with one of the biggest companies on the planet. I'm not going to mention their names. They get enough publicity as it is, but I represent every single one. But an A double plus carrier, 100 out of 100 on a Comdex score, and then you can go overseas and live your life without worry. So, and oh, by the way, and if you say, well, what happens if the big ones go to bed? Then it's anarchy, and I'm fighting you in the grocery store for white bread. You know, that bunny bread, that really nasty bunny. Then me and you are having a fist fight over that. It's anarchy if these big companies go out of business. It's not going to happen. I know there's some people out there going, well, it could happen. No, it's not going to happen, period. So next question. We have no children, so really don't need to leave anything on the table. Any suggestions? If you're buying a lifetime income stream annuity, then I would buy it joint life only. You know, have to look at your ages. You know, once again, we had that question earlier about somebody who's younger than you, much younger. But if you're in the, you know, within 5 years of each other from a spousal relationship type thing, then let's do joint life only. Let me explain joint life only. Joint life only means that when the one spouse dies, the income continues uninterrupted and unchanged for the surviving spouse. When the surviving spouse dies, money goes poof. And joint life only would provide the highest contractual guaranteed payout on the planet because you're shouldering some of that risk. They're going to pay you as long as you're breathing, but once both of you stop breathing, then the money's gone. So in your situation, the structure, if you're looking for lifetime income, would be joint life only. Okay? Anything else?
This is our last question coming up. So if anyone has any questions, please post them now.
Great. Okay. Alicia, if a spouse gets an annuity and they pass away, and then it goes to the spouse, does that mean that the kids cannot get it after their spouse dies? Okay, let's talk about that. Alicia, let me see if I'm going to filter what you're saying here. You get a joint life payment with your spouse, and your kids are beneficiaries. And, you know, the husband passes away, which means the money continues uninterrupted and unchanged for your life. But when you pass away, if you structure it joint life only, then the kids get nothing. There's no beneficiaries. If you structure it joint life with cash refund, then they're going to get the lump sum of whatever's left in the account. Because remember, lifetime income with annuities is a combination of return of principal plus interest. You're drawing down on the asset. And even if the account goes to zero, the annuity company's on the hook to pay. But let's get to the question here. If you set it up joint life with installment refund or joint life with a period certain, and the second spouse passed away, then whatever's left in the account would be paid in payment form to those kids until the money's exhausted. But a beneficiary, and let's be real clear about this, a beneficiary is not going to get a lifetime income continuation. So in other words, if you're joint life with your spouse and your kids are beneficiaries, we can set it up so that they can get the money either lump sum or in payment form of any money that's left over, okay? But they're not going to get a continuation of the lifetime income stream when the second spouse dies. I hope that cleared that up. All right. Next question, good one. What do you feel is the lowest Comdex score we should feel comfortable with? You know, that really depends on the type of annuity in my world. Because let me give you an example. If you're saying to me, hey, Stan, I need a lifetime income stream. Okay. I need a lifetime income stream that I'm going to feel comfortable with, etc. I just have and this is just me, and I'm sure people will disagree with it. But if you're talking about lifetime income, we got to go 80 and above on the Comdex score. Just for me. That's just me. That's the way I roll. But if we're talking about MIGAs, multi-year guarantee annuities, and we're doing 5 years and in, or 2-year MIGA, or 3-year MIGA, remember, MIGAs are the annuity industry's version of a CD. Okay. If we're buying that, then I'm not looking at the Comdex scores as much. I'm looking at the carrier to see if they can back up the claim for that specific time period. So there might be a B double plus company that we like that has a 3-year guaranteed MIGA. We're only going to be there for 3 years. So I'm making my decision and recommendation on, can they back up the claim for 3 years? Because after that, we're gone. Then Comdex scores don't apply as much as they do with a lifetime income stream. Because lifetime income stream, we're transferring the risk as long as you're breathing. So at that point in time, we're 80 and above. And here's the thing on the Comdex score. Here's the thing, though. Comdex is not perfect. The 1 to 100 score is great. But if companies don't retain all 4, AM Best, Moody's, Standard & Poor's, and Fitch, to rate them, and it's a pay for play, by the way, then they get dinged a little bit on the score in a lot of cases. So it's not perfect, but it's the best that's out there. And it's the only service that shows all 4 rating services. I know people out there going, why don't you list Weiss? my friend Martin, and we just don't, because he's been a curmudgeon on all this stuff around. He's been wrong on a lot of this stuff. He's very, very anti all annuity industry. I think AM Best, Standard & Poor's, Moody's, and Fitch is a great way to look at it. And then Comdex score is easy to understand, 1 to 100. But if you're buying SPIAs, DIAs, deferred income annuities, QLAC, qualified longevity annuity contracts, or we're buying income riders, I'd like for it to be 80 or above. Are there exceptions? Sure, there are exceptions, but most of the time it's 80 or above. Pete, can a beneficiary of a MIGA with a surrender charge on death benefit wait to take the proceeds until the maturity? The only beneficiary that can is the wife. The wife can continue the policy, but let's say your son is the beneficiary. The answer is no. Okay. Anything else? Sean, can you purchase an annuity in a solo 401k? It depends on who the provider of that solo 401k is. The answer is yes in most cases. But my question to you is why? 401ks are accumulation products. They should be for growth. Okay, they should be for market growth. So under that premise of it should be for market growth, and that eliminates all annuities. I know that my annuity brethren and brotherenettes out there are yelling at the screen, but I'm right. If you're wanting true market growth, you don't need annuities. But yes, you can purchase these inside of a solo 401k. I would just have to know a little bit more about you, your age, your goals, and what you're doing. Most solo 401ks are entrepreneurs. Most solo 401ks are business owners. Most solo 401ks are for people that are working, or going to continue to work, and that need growth. Okay. Alicia, my question really was, if you got, this is a follow-up to the other one. If you got an individual annuity with a spouse, and the spouse is the beneficiary, can it go to the kids once? Yes, it can. So let's look at this, Alicia, and I think I understand your question now. If the spouse is the beneficiary and the kids are, let's just say the spouse is the primary beneficiary, 100% is going to go to the spouse if something happens to you. And then the kids, let's say you have 2 kids and they're secondary beneficiaries, 50-50 each, and your spouse dies, okay, and you're still alive, then the kids move up to be primary beneficiaries, 50-50. That's how that works. Okay. Chuck, I like that name, Chuck Bracey. If you have an indexed annuity with an income rider inside of a Roth IRA, are the payments taxable after the account value is up? I don't think so. Producer, CEO, I don't think so. Weigh in on that.
I don't believe so either.
No.
I would have to research it to make sure, but again, we're not tax experts. We're just going off of what we know.
Exactly. We're doing this a long time, but have not. The Roth IRAs are so new from the standpoint of them implementing it, and income riders are relatively new as well. Do some of our clients have income riders with inside of a Roth because they wanted it there? Yes, but we haven't gotten to the point where the account's at 0 yet. So I don't have a real case, real world example. Now, the CPAs that I use and have on retainer, the tax lawyers I've had on retainer, and I've asked them this question, they have unanimously said, no, it is not after the value is used up. They have said that. I'm not hedging, but I'm not a tax expert. That lovely voice you said you heard on this was Leah. She's the director of operations, CEO of the company, and she's been in the business a long time as well. But I think the answer is no.
That is it for questions.
Hey, I appreciate you joining me. That was a lot of fun. We do this every single month. I encourage you to go to my site, run quotes, get the books, schedule a call. And also, too, remember my Fun with Annuities podcast. It's not about annuities. If you've listened to it, we have some really good guests on every single Tuesday. Hey, thanks for joining us on a Saturday. I really appreciate you being here, and we will see you next time.